What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. In today's episode, Stephen and I will be speaking with Danny Kirsch, head of Piper Sandler's options trading desk.
Danny, thanks so much for doing this today. Super excited to talk to you. There's just so much going on in the market. We see these huge moves every day, but yet we're near all-time highs. What are you talking to investors about?
Yeah, so I think yesterday was a pretty interesting day in this week where you've gotten almost these false starts of market selling off, huge intraday swings, and that, like one of the questions we got. So yesterday we sold off 63 bips. We had a really large outsized move in VIX and volatility markets. And when we say outsized, what we're talking about is, so the VIX was up 4.5 points. But really what that means is if you owned an S&P 1 month put that had like a 25 delta, and based on yesterday's move, so you move 60 cents lower, you make 25% of 60 cents. Let's just say, keep it simple. What is that? That is, you make 15 cents, right? Yesterday, if you had a 25 delta, you were making way more than 15 cents. And that's when we say that there's a big volatility spike. And that's why the volatility spikes matter, because your delta outperforms. So you get an outsized return on those puts beyond the 25 delta that you normally would. And what that means is a few things. One, people are clearly buying puts. They're looking to add exposure. They're worried, maybe a little panicky. Perhaps people are short too much vol, like VIX calls, tails, whatever it is. And so you're panic covering. And you're willing to overpay for downside or overpay for volatility relative to how much it's actually realizing. So, these things happen. Sometimes it could mean more volatility is coming. And what we saw this week, the volatility had been generally bid all week. And then we had yesterday were really spiked. And it could mean there's something underneath the surface that's really bad. And typically you look to the credit markets because that's where things really break fast. And we had some not great regional earnings data yesterday. But a lot of it is more, I think it's more contained and more fraudulent. And the bulls would say, well, this happened when SVB blew up, and that was actually really bullish because it got the Fed to be more accommodative, and you just paper over all these problems quickly, and this is a buying opportunity. I would disagree, but you saw this morning where Trump kind of came out and said, okay, we're cool with China. And then we're getting this rally. And so a couple things. So you have that big vol spike, and now what happens after that? We saw in August of last year, that actually triggered a huge rally. You had a big vol outperformance where I think people got stopped out on short volatility trades. You had the VIX explode over 50 on a very small move. A much smaller version was yesterday. Now, why did we rally so fast in August of last year? We kind of took off for the next 6 weeks. We never really went down. And I think there's some macro news, but I think on the volatility side, you need some sort of positive catalyst. But that delta pickup, that all works in reverse, where now I hedged my puts. I sold you puts. I hedged them on a 25 delta. It's acting like a 40 delta. So I got to sell more stock. And that as the person short these puts, I got to sell more. Now the reverse will happen. If we get some sort of positive news this morning, we got Trump saying we're cool with China. It's going to be fine. We're going to lower tariffs. You get this rally, and that rally accelerates as people who are short put and short stock, because that's how you'd hedge a short put, you'd short stock. Now their delta that maybe acted like a 40 delta will act like a 20 delta. So you're going to covering stock. When I say moves from 40 to 20, that means you're short put, short stock. Now you're just short less stock. So if everyone is doing this, can help further rally. And this is why we always keep an eye on when volatility outperforms, both on the downside and then on the upside. This can be a nice way to sort of stimulate a rally as people who are the market makers are unwinding their short deltas.
Well, Danny, outside of the China-U.S. trade headlines, what do you think, given that the market's very focused right now on regional bank issues? When you look back in August of last year, I think the clear catalyst for that sell-off was 4 or 5 months in a row of acceleratingly bad employment news, and we started getting literally the opposite beginning in early August. Claims fell, the unemployment data started falling, and payroll data was good. So I think it was clear back then kind of what the market was afraid of and what the market needed to see to relax its fears. What are people looking for with this regional banking issue? Like, it's not a clear data point? Is it just the absence of any further escalation and bad news? Is it earnings?
Yeah, I mean, you had decent earnings this morning. Like FITB had good earnings, and again, I almost think like the regional bank issue is like a kind of a microcosm of what the entire market is, where you
Yeah.
had incredible earnings out of Morgan Stanley, Goldman, JP Morgan. I mean, Goldman less so, but Goldman, JP Morgan, Citi, record trading volumes. I think Morgan Stanley said there's zero loan loss provisions, zero. And at the same
Mm.
time, you've got like companies like Jefferies, Zion Bank, Western Alliance Banks saying that they might not necessarily credit issues. It's more like bad underwriting and fraud issues where they're
Yeah.
involved in things they probably shouldn't have been and didn't do enough due diligence. And so I think that's why people think it's fairly contained. I think the other issue with regional banks is going into this year, you'd ask people like outside of tech, what do you want to be long based on Trump winning and the deregulation and
Yeah.
maybe an easier, maybe him pushing on Powell. It's like, oh, and M&A, regional banks.
Yeah, that was everyone's favorite.
And so what do you think it's done this year? Down now, as of after yesterday, down 1.8% on the year.
Yeah, kind of flat. Yep.
Yeah, so it's like I think that like the market does seeks to be painful, and I think this is a smaller sector. And now it's like, well, maybe it's just an area that people are going to avoid for a while, and perhaps that creates some opportunities. But I just don't think people think this is a systemic sort of issue. And there was a lot of froth on like the consumer finance names like SoFi Bank, names like Ally, names like Affirm, sure, Pagaya. So I think that you're pulling some of that froth out, but as far as like bigger risks, the fact that big banks had such good earnings, it's just more of what we've already seen and sort of what you've been flagging for the last year. It's like the higher quality, larger companies tend to be a better place to park your money. Whether that continues, less clear. I mean, obviously Russell's had a big rally, but
Yep.
I think that's very true in the banks, and the earnings showed that.
Yeah, I think the name of the game over the last couple of years, and I think definitely going forward still, is recognizing there are a lot of risks out there, and it's a minefield of problems. But understanding and having a view on whether or not those problems will remain idiosyncratic or become systemic is the key. I feel like nowadays, with so much social media and symbolic views, anytime people hear a problem, they initially think they like almost immediately go to like, it's going to be systemic and it's going to cause this and that and this and that. And that really hasn't happened. And more times than not, it doesn't happen. But I think that's going to continue to be a struggle, not getting wrapped up into that hyperbolic view. I do have a separate question of the context of today. I'm actually glad you're on talking about volatility. Obviously, we're in a booming tech-led market. People love to talk about the late 90s and 2000. And so one of the things I admittedly never fully understood, so maybe I'll understand it now with you here, is if you look at the late 90s, volatility went up the entire run in the market. The VIX started at like 10 in 96 and went up, and up. We had the Asian financial crisis, 97 and 98 LTCM, but it was a straight trend higher all the way through like early 99. And then we had the VIX kind of top out until things really started imploding in the markets. What was the dynamic there that led the VIX index higher? Because we're certainly not seeing that today alongside the rise in tech stocks. And is it possible for that to happen? Does that mean anything that it is or not happening? I know the options market's quite a lot different today compared to 20, 30 years ago, but I don't know if you want to hear if you have any thoughts on that.
I'd imagine it was like anything, it's always realized volatility. That's why like when like the VIX is a good indicator. It's like I always think it's a good indicator when you have days like yesterday where it explodes, but on a small S&P move. I think in the instance of the 90s, you had huge up days coupled with huge down days. Like you had huge corrections amidst the bigger, broader rally. And I think people have sort of cited that a lot as like what might go on here, where you'll have corrections, but it's all part of the same sort of run. So I think that certainly is part of the case. And I'd imagine there was no shortage of demand for calls. The big other difference is like there wasn't weekly calls, there wasn't daily options. So the way to hedge, you had to buy a month out, 2-month puts, whereas now you can buy 1-day puts if you're worried about tomorrow, or intraday puts that expire at the close and are cash settled, or you can trade them overnight. So I think the ability to hedge, the liquid tools to hedge, there's just way more now. So I think that's part of the reason why you don't see these huge volatility. Like you won't see volatility sustain at a higher level. I also think there's a much bigger demand for yield now. There's ETFs like Yield Max, for instance, that writes 1 week calls on Tesla and they roll them every single week to create yield when really, I mean, it's kind of eating into your principal in the form of yield, but that's a different discussion. So I think you're less likely to have sustained high implied volatility because there's so much demand for yield, so much ability to hedge. And because of that, it almost creates these, I think it's like this similar like the market where large cap can dominate small cap for long periods of time. I think you could have really quiet periods for long punctuated by huge moves. But I don't think you'll have sustained high volatility in the current market structure.
All right. Well, thank you. That certainly helps clear.
Unless there's a pandemic, I guess. Then there could
Well,
be.
yeah, but you're probably not going to have rising stocks and the onset of a pandemic again. Who knows? Maybe market will be forward looking and see more stuff.
What's the look back period? Isn't it 5 years? So if we get one in like 3 years, then probably same thing happens.
Yeah. So we're supposed to get CPI next week. What are you seeing on your options pricing, looking at the zero DTE stuff for single day market implied risks, looking at the next week or so?
I think it's over 1%. It was before yesterday below 1%. So for the October 25th, so the nice thing is with options, the S&P has daily expiries, I think going out a month. So what we can do is back out 1 day implied moves. We can back out 1 day implied moves for each incremental period. So we'll show like, hey, for payrolls, this is what's priced in. Obviously, we haven't had a payrolls. For CPI, I think we were at 1.2%, which is low, which is high relative to history. But I think it somewhat makes sense. But we're going to get like all this data kind of coming at the same time, and the Fed's going to cut. So I think this one might be a little bit less relevant. I guess if it comes in really high, it's a problem. Do we expect it to come in high? I thought I saw our eco team had it sort of in line.
Yeah. I don't think they're predicting anything outsized. And just looking, I mean, I look at oil every day; it just keeps going down. And I talk to clients and point out that the real price of oil, we're at $57, but the real price is basically at a 25-year low. Like that is massively stimulus in a vacuum on its own. It's really hard to create inflation when you've got real oil prices just falling and falling. So I think the market's going to get okay or better inflation news. And we can see rates coming down for a good reason. And I think that's what's going to give us a nice leg up into year end.
Yeah, and I also, we're getting to this period. November tends to be a seasonally strong time of year. I think some of it is you get mutual funds doing like their year end is end of October. So you get like this selling losers into that. And then you get this nice rally of some of those losers. And we've done a little bit of work there as well, that you do kind of want to start buying losers in November. And then you certainly want to do it in January to just get long the tax loss sellers. And we've pitched that before. And the other thing that's really beneficial in November, especially if volatility is going to be a little bit higher, holidays are bullish, which again, this sounds idiotic, but there's a reason July and November are seasonally very strong months to be long. And the reason is this thing we talked about, this delta decay. So again, you own a put. As time passes and we don't move, the delta shrinks. And if I'm short that put, as the delta shrinks, I have to cover some of my short stock I sell against the put. So just Thanksgiving is bullish. It's so stupid, but it's true. And if you look at like SEAG on Bloomberg and look at the monthly returns, you'll notice November and July, very good months to be long. It's not a coincidence. That's 4th of July and Thanksgiving. It's not a coincidence. There is a structural reason why it makes sense to be long in those months. In November specifically, because you also have this sort of the mutual fund, like window dressing at the end of October. Again, money redeployed into November. Beyond the fact that we've got accommodated Fed, deregulation, China, whatever. China, I guess, deal at the end of the month because Xi and Trump are supposed to meet at the APC summit in Korea. And then I'm sure there'll be some sort of delay or whatever. Or maybe they'll buy soybeans and we'll give up all of our tech, whatever. But probably good for the market.
Agree. It's hard to see Trump causing an unforced error on himself.
No, I think there is some like tells, like there are some tells like Jameson Greer the other day saying, yeah, we keep an eye on the market. Trump this morning, when the market was down 1%, oh, we'll figure out a deal with China. It's like, I think they do care about where the market's going. And it seems they have this finger on the pulse. And a client made a comment to me a few days ago, until the midterms, the strike of the Trump put keeps growing up through the midterms.
That's fair. I would agree with that. It's funny. I remember earlier in this year, around late April, I was in Europe, and that was a time where the view on European equities was much different relative to U.S. equities. And I think that's kind of flip-flopped again. towards a bullish U.S. backdrop, but many European clients were arguing that the U.S. market deserves a higher equity risk premium because of the administration. In other words, because President Trump is who he is and what his policies are, and there creates a lot of uncertainty, that the market deserves to be cheaper, almost like an emerging market deserves to be cheaper because there's no property rights or the government can just come in and do anything they want. And I was arguing that it could be the other way too, because companies are afraid to go against Trump, anything he says. Investors are afraid to short any bad headline news because of the taco idea. And he talks about stocks every day. So perhaps that's one of the ingredients to a higher multiple for the remainder of his term.
Right. And we saw this in 2017. And before the pandemic, we had very low volatility and a market that acted very well. And then when the market didn't act well, he was hounding Powell to cut. So we're seeing it again. This time, though, he'll be able to install a different Fed chair, who I'm sure will be very accommodative. And again, the deregulation side is very meaningful, I think. So it's just, I think it'll be difficult to be short, at least near term. I wouldn't want to be like super short into the midterms unless something really changes. Just stay long, it seems like. I don't know. I mean, like, I think there's certainly areas to get short that are like well beyond their skis. I think probably like rare earths, some of the super high beta stuff that is very pre-revenue.
We keep getting asked what the risks are to that. And I think actually it's that we get some better economic data and yields back up a little bit. And that could take some of the air out of the stocks that we were talking about this morning. What are the risks to these stocks that have just gone to the moon in the last 4 months as rates have come down and Fed expectations of more rate cuts have increased? Well, anything that could start to reverse that, even if it's a better economy. So we think the data is going to be surprisingly good in the first quarter of next year. We think the housing data, which has been surprising to the upside very strongly, will continue to do so. And for us, as long as we can keep rates from moving up materially or some exogenous shock, which is, of course, hard to predict, but I don't think employment is weak enough to cause an exogenous shock or propel one. So I think we are in a Goldilocks state. Everyone disagrees, but yeah.
And then I get that there's a big trade tied to AI and the CapEx cycle, but I think near term, and this is like we had a CIO dinner on Monday, a lot of people are talking about like the OpenAI and this being the winner when it's all said and done, but they think the next 6 to 9 months, like the funding's there, you're going to keep seeing people build. The debt markets are clamoring to lend money to like an Oracle. I think it was 4 times oversubscribed, their most recent debt deal. So for the time being, even without the ability necessarily to like the obvious, like there's not obviously enough revenue there, but you're seeing like OpenAI make a deal with Walmart. You're seeing like they are thinking about ways to make revenue from what they're doing, and they have 800 million users. I'm sure they'll figure out how to get paid and grow fast. I don't know. It just seems like I hate being like so bullish, but you'll have like pockets like this, but it's like this really like Jeffrey's like fraudulently lending money to first round. This isn't going to derail everything, I don't think. It'd be more so a deep seek moment, something we're not seeing.
All right, Danny.
Thanks for having me, guys.
Have a good weekend.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.